Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I hope that everyone had a relaxing Memorial Day weekend. I hope that you guys are staying safe with your families, and let's go ahead and start taking a look at where the markets are trading because we're about to open up substantially higher than where we closed on Friday. Markets are in much more of an optimistic tone here this morning. So let's take a look at the data that we're currently looking at and how we think you should position going forward. So before we do, just a quick disclaimer here, what we're going to discuss here today is purely for demonstration and educational purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So let's first start off by talking about where we're currently trading in the overall market. We've been looking at this chart for quite a few weeks now, where the markets dropped, substantially, came back to rally. Over the past 4 to 5 weeks, we've really struggled here around this 285, 280, 295 level or so, and it's been pretty much range bound for quite some time. We had pokes to both sides. 2 weeks ago, we had a poke to the downside. It looked like things were starting to unravel, but quickly reversed higher. Last week we opened up substantially higher above that range, but then spent most of the week consolidating back into the range. And today we're now breaking up to the upside. We are now testing 300, 302, the level that we've been talking about for weeks now. This is a level that we referenced heavily back towards October, November, which was the level that, if those of you that remember trading last week, we tested multiple times throughout between April to November before finally breaking out. And that breakout is what drove that just November to February rally from 300 to 340 on S&P, where during that time, there were a lot of, I would say, deja vu moments to where we're currently trading right now, where you basically had a market that continued to march higher despite not really seeing the fundamental backdrop as far as why they were rallying so much. As we rallied, momentum continued to decline. These are exactly the same type of mechanics that we're currently seeing in the markets, because as markets continue to rally higher, momentum is not confirming those moves higher. Money flows remains very weak. But again, despite all of these things, what we learned from November to February is the fact that that can go on for weeks, that can go on for months on end, where markets aren't necessarily giving us any type of fundamentals or economic numbers that continue to support the rally higher, and we are starting to see signs of exhaustion in the markets, but markets continue to move higher. That's exactly the position that we currently are in, and that's a position that we are positioning ourselves for the next few weeks, for the next few months. As far as when markets may reconnect with some of the numbers that we're currently looking at, don't know. When that can happen, certainly don't know how that will happen, but when it does, we certainly want to make sure that we're prepared. But before that happens, we want to make sure that we position ourselves correctly for this continuing move higher. Now, we've been looking at this also for the last few weeks, but technology continued to move higher, still the strongest sector at this point, leading the move higher. This is, I think, not surprising at all that technology continues to move higher. I think that as we continue to remain fairly locked down in most places, we realize that the shift in terms of how we're going to work going forward is going to change. We're not just going to go straight back to our offices. There's going to be a lot of companies that's going to be rethinking, do I need to be paying for office space for my employees? My employees may be even more productive at work than at home than they were at work. So you're certainly going to continue to see technology companies, especially ones that invest in security and help facilitate working from home. Those are names that are going to do very well. Even consumer electronic names like Apple, I think, will continue to do well in this type of market environment. So these are the names that are moving the markets higher. The NASDAQ 100 index, by far the best performing index out of the major indices, just a spitting distance away from its all-time high. My expectation is you're going to tag that all-time high, maybe consolidate a bit below that, and then see a push higher. I certainly think that you could see new all-time highs in the NASDAQ 100 index relatively soon here, given where we're currently trading. But I will say, in these indices, you still have the same issue where as markets continue to move higher, momentum's not really confirming it. Money flow is fairly weak here. So be careful as far as continuing to step into bullish positions in these types of names. We'll talk a little bit about how we're positioning for it, but you're seeing it in our daily plays. We're using more debit type strategies nowadays than selling credit spreads, which is predominantly what we were doing inside of this type of chop, right? When the markets weren't moving very much, we were selling credit spreads. Now that we have this breakout to the upside and volatility is now lower, now we can start thinking about buying some debit spreads. And those are some of the names that we're looking at. The other thing that we started talking about last week, and this is really starting to come back to life even further now, is really small caps. Small caps have joined this rally. This is further support for this rally. This is more data for us to be comfortable with continuing to push longs in this type of market, despite the stretched valuations, is you get broader market participation that provides further support of this move higher. Everything that we've been taking a look at, VIX moving lower, oil, even the number of stocks that are above its 50-day moving average, 20-day moving average, and 200-day moving average continuing to improve. So market breadth is showing us that the broader market is participating on this rally, not just the mega cap names that were originally dragging this market higher when we first started doing these types of sessions. The broader market has now joined the rally. This is supportive and the data that we're looking for to continue going long. So number one, don't fight the charts. Both weekly and daily charts clearly are very bullish. We are testing some major resistance levels at 300 and 302, but don't forget that the weekly and daily charts are very strong. Don't want to fight the Fed, and you certainly don't want to fight the charts right now. VIX well below 30, as I said, looks like we're about to open up about 25 or so. Oil stabilizing around 35. So these are all indicators around the equity markets that we look for that provide further support. We also looked at silver last week. Silver looks like it's going to potentially open up a little higher as well. So you have a lot of economic real-time, I would say, numbers that are supporting this particular rally as well here. So liquidity looking quite good here, 319 very liquid optionable symbols as of Friday. We don't have updated numbers here as of today yet because we haven't opened, but as soon as we do, we'll update you. But I expect that number to look fairly strong here in terms of liquidity. And, the one thing that I will point us here is really just global central bank data and the Federal Reserve, because when we look at where the markets are currently trading and then we look at economic numbers, which I think is very important for everyone to stay on top of where economic numbers are. But remember, economic numbers many times are lagging. They can be lagging for weeks, if not months. So sometimes you might look at an economic number that doesn't match up with the markets and you say, hey, I think it's a time to short. Be careful as far as how you're thinking about those economic numbers. But I will say the one indicator that we want to pay attention to is really how much are the central banks pumping liquidity into the markets? How many assets are they buying? Because that really is the one chart that matters, even though I think that it's important that you stay on top of economic numbers and understand where those stand. The thing that's driving the markets is less so those economic numbers and even corporate profits, which at this point, in my opinion, will probably take at least 1 to 2 quarters to catch up and provide the type of perhaps downside move that you might be looking for. But for now, the one indicator to pay attention to is really global central banks. And I have a couple of charts to show you here. And some of the names that we're starting to pay attention to and look at is some of the names that we've been saying for weeks to, it's not quite ready to rally. It's not time to get into those stocks now. We've started to see the spark here. Airline and travel stocks starting to come to life here this morning. Time to start taking a look at some of those names. We still continue to want to take a look at technology, specifically e-commerce stocks. So quite a few names for us to potentially look at here this morning. So first of all, what I wanted to show you is the one indicator that I think really matters, despite all the economic indicators that tell us otherwise, is really the central banks, the number of assets that are sitting on central bank balance sheets. And this is just major economies. The blue line, as you can see, major bump since COVID-19. That's really what's driving the rally here. And as you can see, since 2019, the blue line, which is the central bank assets versus the MSCI Global World Index, Very high correlation here, 95% correlation between those two data sets. So as central banks continue to expand their balance sheets, and you see the rhetoric that has been coming out of these central banks in terms of providing effectively unlimited support to fight this crisis, that's really what's driving the optimism here. You couple that with the fact that you have some reopening trends that look positive. You couple that with the fact that you have pharmaceutical companies working on vaccines, pharmaceutical companies working on treatments for COVID-19, and a lack of other I would say downside risks, even though in my opinion there are tons of downside risks and potential geopolitical risks that can unstabilize all of these things. Despite all of that, markets continue to march higher. And that's really, in my opinion, the most important indicator for us to take a look at. The reopening data certainly is starting to pick up a little. And I think that's really what's compounding the optimism we're currently seeing in here in this market since basically May. We've seen slow uptick in terms of restaurants. This is open table data, giving us some indication as far as how many restaurants are open, what capacity. We have some data out of China to share with you to give us somewhat of a template as far as what that would look like. As far as Google data looking at reopening, the one trend that seems to have peaked, that seems to have improved substantially, really people trying to get back outside, right? And I don't think this is surprising at all. And I don't think it's surprising that parks is where people are going predominantly, because that's really where you can get out to nature. You can perhaps practice social distancing inside a park. You can't really do that in some of the more confined spaces. So not surprising to see people wanting to go out into the parks. But as you can see, workplace and transit still well below the norms. We're looking at more than 40% decline in those, not really seeing any significant uptick over the past few weeks. Certainly not in line with what we're seeing here in the restaurant stocks. So, or restaurant data. So still, as far as reopening, you're going to see very specific segments of the economy reopen significantly faster than others. Restaurants still, again, starting to see that uptick, but not quite anywhere back to normal. One of the interesting data points is that 93% of restaurants in China are reopened, but as you can see, the number of orders is still hovering somewhere around the 60% mark, which means that even though most restaurants are open, they're seeing substantially lower utilization, substantially lower order value. That is going to be concerning for us going forward. But again, that type of data showing up in earnings is going to lag by 1 to 2 quarters. So during over the next quarter or so, you might see these stocks trade on fairly optimistic tones and really price to perfection is what I call it, and then maybe coming crashing back down to reality in Q3 or Q4. So that's the type of expectation that I have with some of these types of stocks that are seeing substantial rallies, despite we know the fact that the economic backdrop, the amount of money that their consumers are going to have to spend over the next few quarters is certainly not going to look like what it was back in January and February. So despite all of that, and we know that markets are trading at higher valuations, we think that markets can continue to stretch even further valuations before things come crashing back down to reality. We've been referencing Bank of America credit card data for quite a few months here now, and that some of the data sets is that it's starting to normalize here over the past few weeks. It really has been pretty close to 15-20% from normal, 15 to 20% away from normal, so substantially looking better. But this data continues to improve, and we had multiple days where we're very close to normal, if you will. So certainly edging closer to that in terms of how people are spending. So this is all supportive of this current rally. This is all supportive of the current optimism. And that is how I think we should be positioning ourselves right now. And keep in mind, one of the things that we started to talk about last week, and one of the things that we have been using in our own daily play positions, is really switching and start thinking about an option strategy that allows us to continue to gain long exposure in this market, especially in some industries that we may not be comfortable outright buying these types of names, buying these stocks. by using strategies like debit vertical spreads. So debit vertical spreads really allow us to take long exposure in a specific name with the least amount of risk, especially when this type of market environment where volatility is not high and it's not really low. Debit spreads really is one of the best strategies for us to utilize in this particular market, because if you do get some kind of pullback, right? And this pullback can materialize next week, it can materialize next month, maybe it might even be next year before it materializes. I simply do not know when it's going to happen. I don't think many people do. And you want to make sure that you position yourself before that happens for continuation of the market higher. But if and when that pullback materializes, you want to make sure that you're protected in terms of your portfolio. Sure, you can buy puts at that time. You can certainly be prepared to buy puts, but the better way to protect yourself, in my opinion, is to simply utilize option strategies that have limited risk to begin with. So if you're gaining some long exposure in some of the names we're going to look at here today, do so with strategies that provide you with upside exposure so that if the stocks continue to move higher, you make a return on that. But if the stocks retreat lower, you have limited risk. So let's take a look at some of those names that we want to pay attention here today. So first of all, these are not specific names necessarily that I want you to take a look at. These are more the types of names that I think you should potentially look at. PayPal. And the theme here is really e-commerce, right? So we've been talking about this for the past few weeks, a clear bifurcation between retail stocks, between online versus physical stores. We have a huge amount of shift of spending from physical stores to e-commerce. That is likely going to continue. You're going to see new trends emerge from this particular space, but names like PayPal that have 100% card exposure, that process 100% e-commerce sites. They don't have any physical stores or virtually zero physical stores. They also process payments for Airbnb and Uber. These types of names that are going to start coming back as you see travel travel data lift off from the bottom as you start to see these states reopen their economies. People are likely going to feel uncomfortable getting back on a train or mass transit. They're more likely to take Uber. So names like PayPal are really going to be net beneficiaries of this economy as we reopen over the next few weeks. And these are the types of names that if I'm trying to look into playing, that I prefer utilizing a debit spread in this particular case, rather than selling premium as we have been doing over the past few weeks. So buying a July 150-170 call spread costs $6.90. And just to give you a sense, $6.90 on a $150 stock is only 4.6% of the underlying stock price. So even if you get some massive pullback where all of a sudden, I don't know, we reopen our stores and everyone starts shopping in physical stores because people miss going out to stores instead of going online, and PayPal comes crashing down, you're risking 4.6% while potentially getting that long-term exposure, that long exposure, so that if PayPal does rally up to, let's say, 170, you're getting 189% return on your $6.90 invested. These are the types of risk to reward ratios that you want to start positioning yourself for in this type of market environment. And despite the stretch valuations, these are the types of sectors that are seeing these types of big gains to the upside, and utilizing call spreads is the best way, in my opinion, to capture those potential gains to the upside, but do so in a way so that if you do get some type of pullback, you are doing so in a way with limited risk. So PayPal, is just, again, an example of the type of stock that you want to start thinking about and investing in post-COVID-19. Airlines, we've been getting a lot of questions regarding airlines. I will say not all airlines are the same. Delta, for example, has roughly about 11 months of liquidity. American Airlines has about 5. So big difference there. So as you think about some of these travel stocks and airline stocks, make sure that you do your research as far as how much liquidity these airlines have. I would even say that perhaps don't invest in a single airline. You might be taking on too much risk. Think about some of the more broader travel-related stocks like Expedia or Booking.com that is more diversified, that is likely going to benefit from a broader pickup in travel across the board. And you can focus more on retail. You can focus a little bit more on corporate, depending on where you think that market is going to be going. But airline stocks, Delta, I think, is about to open about 7%. We've had this triangle for the past few weeks We were looking for a breakout in either direction. A couple of weeks ago, it looked like it was going to break out to the downside, but looks like that's not happening. It looks like we're about to break out to the upside instead. And that certainly puts quite a few levels to the upside that are potential targets. You know, we're currently trading at around 24 or so. So if it gets back up to that 32, 37 and a half, that's a big move to the upside. And you can do this, and you can do so, in my opinion, with limited risk. Now, the risk is going to be substantially higher than a name like PayPal, but still substantially lower than the stock itself. So buying a call option here, $2.22. Now this is before the market opens, so I think the market's going to open a little higher here. You're going to risk about 9% here, but substantially more risk in a name like this. You know, this stock was moving 9% a day for quite a few weeks, even very recently. So risking 9%, in my opinion, relatively small risk to take, shooting for 200-300% returns to the upside if you are correct, and this type of industry does see a short-term rally back into that $32-$35 level relatively quickly. So, you know, as we said over the past few weeks, I don't think it's time yet for these types of names. You know, with travel data starting to pick up, you might start taking a look at some of these types of names. But again, be careful in terms of your research for specific names. Hotels also seeing some substantial pickup. Marriott reporting earnings even a few weeks when they reported earnings, they were starting to see an uptick in numbers, but it was still pretty much within this range here of about 95 and 75, but looks like it's about to break out to the upside. And you have the weekly chart that still has a 200-week moving average up about 100. So you certainly should likely get a nice push up to that 100. If you get a push back above 100, that's really where you can see some substantial gains to the upside in a name like Marriott. Now, again, Marriott's obviously not the only hotel chain, certainly not the only travel-related stock. So do your research in terms of which names that you like more. But again, this is the type of industry that are starting to see some gains to the upside for this market going forward, or at least as we open up substantially higher this week. It's going to be driven by a lot of these types of names going into a very optimistic week. Restaurants, same thing. There are plenty of restaurant stocks that you can choose from. I just gave you an example here, Darden, because they're one of the largest, but everything from McDonald's to fast casual like Chipotle and Shake Shack, these are all names that you're likely going to see some outsized moves to the upside as markets become more optimistic about reopening, as consumer spending data looks relatively normalized at this point, that you're going to see these types of names have big moves to the upside. But again, do so in a way utilizing options so that if you do get a pullback, you're doing so with limited risk. Here you're paying about $6.40 for a July call spread on a $75 stock. So you're risking here about 8.5%, a little less than the airline stocks, a little bit more than some of the PayPal names. But the goal here is to risk 8%, because if you do get this type of pullback, you're not risking, you don't want to risk 30% of your portfolio on a stock like this that is extremely sensitive, I would say, to any potential shocks that we might see in the market. You want to make sure that you're doing so in a way with limited risk here. So anywhere from 4 to 8% is likely what you're going to see in this type of market environment as volatility starts to pull back. You know, as we said, we're opening up around 302, 2.25% higher than where we were trading here on Friday's close. So substantially higher. Even my trade from options action here on Friday looks like it's about to open up substantially higher, 101. So I still like this particular name. You might have to adjust your strike prices maybe a little bit, or certainly pay a little bit more to get into the spread. But again, I like this particular stock and the potential of breakout here. So that's just a quick note here on that CNBC trade. And lastly, I wanted to pull Apple. Apple also within spitting distance of its all-time highs. You know, again, something that if you asked me a month ago whether I think Apple's going to get back to that all-time high number, I would have told you absolutely not, because the consumer sentiment data, the just sheer unemployment we're seeing not only in this country but around the world, and whether people will still continue to buy iPhones and expensive accessories for them. That's not what the market is telling us. That's not where the Apple stock is trading. I certainly don't think that people are going to be buying iPhones at the same clip as they did prior to COVID-19, but the stock is telling us something completely different. I think that you're likely going to get a retest of that all-time high and break out higher here. So consumer electronics stocks, also another category that is doing very well and will likely do well over the next few weeks and next few months as we really start to shift more towards really seriously taking a look at working from home for a lot of small companies, major companies. I think Facebook making that announcement of shifting a lot of their employees to working from home is going to generate a slide of other publicly traded companies announcing similar type deals. I think this is going to put some downside pressure on commercial real estate because people realize that they're not going to need as much office space as they did once before. And as employees, many employees, even if they told me to go back into the office and go back into the CNBC studios, I might not be so comfortable getting back on a train to get back to the studios. So there are a lot of challenges to getting back into the office. And I think over the next few months, even over the next year, you're going to see a bifurcation between commercial real estate and work from home stocks and stocks in that particular theme. So we're going to start putting together some of those types of names to give us a better understanding as to what is the longer term impact, what names are going to likely have long-term is going to be a net long-term beneficiary of working from home, as I think this is just the beginning of this trend. So those are some of the things that we are researching on our end, and we will be producing reports for you guys to let you know how we're thinking about this post-COVID-19 world. So with that, that's the research we wanted to show you here today. Like I said, it's important to stay on top of the economic numbers. It's important to stay on top of the fundamentals, but don't fight the chart, don't fight the Fed, and position yourself correctly for long exposure, but doing so in a way with limited risk. That's the best way for you to protect yourself in this particular market environment. That's exactly how you want to position, during this November to January rally, where we had just a very small pullbacks that looked like they were going to be bigger pullbacks, but never materialized. You were just buying the dips. That is the exact same market environment that we're in. Every time we dip, buy the dips. It's not a particularly fun market, I would say, to trade, because in the back of your mind, you're always thinking, this doesn't quite feel right in terms of markets continue to move higher, but that's where the markets are, and we don't want to fight that. So with that, I hope that you guys find this useful in helping you set up your Tuesday morning. Again, I hope that you guys all had a great weekend with your families and staying safe. And we really look forward to continuing to provide this type of research for you guys so that you have a better understanding as to how to position for this market, because as I've said over the last few months, things change very quickly. What I'm saying to you right now, I've been pretty confident in this type of positioning over the past 2 weeks, but things can change on a dime. We can get some news tomorrow, escalation in China. We can get a second wave of COVID-19 that shuts things down very quickly, and things look very different. So be very nimble in terms of how you're positioning yourself in this particular market. If a trade works out that you liked it, that you traded, take profits quickly. Make sure that you take profits often. That's the type of market environment that we're currently in. So make sure that you position yourself correctly. With that, I want to thank everyone for taking the time out here this morning. I hope that you guys find this useful, and I hope that you guys consider supporting us and becoming a member for us to continue to provide this type of research and build out our platform and do these Tuesday market outlook sessions for you by becoming a member using the link on your screen, which I just posted into the chat window at trade.optionsplay.com/member. So I hope you guys have a great Tuesday, and I will send out the recording to you guys here as soon as we're done. And I hope you have a great afternoon.